This is Justin Pulitzer. This is my weekend review for January 3rd, 2016. Wow, this year blew by, 2015 that is. Really a whole lot of nothing with regard to the S&P. There was a lot of noise and a lot of kind of panic, really just kind of going nowhere, but that's kind of set an interesting stage, and we're going to discuss that here and what my thoughts are for 2016. So let's go through the 6 market keys. They are obviously still relevant in what I've been looking after, and let's use that to kind of gauge where we're going. So the VIX, we know, has been in kind of a compression range. It had a little bit of a flare up here, weren't really able to get over and hold over 25, had a bit of a sell-off here. I guess this was your Santa rally. And then this last week it's been elevating a bit as the market has been, I guess, locking in losses and some people locking in gains as well. We've been talking about the narrow, when I say we, I mean me, been talking about the narrowing of the market's breadth and the focus that it's really been into very narrow subsectors. I mean, if you haven't been in like FANG, McDonald's, Nike, and that cohort and some of the cruise lines, you really haven't been doing, I guess, all of that well. There's been quite a rout in commodities as well as dividend-paying stocks, and let's talk about that. So the VIX here, we had a bit of I don't know if this was a bad tick. It did reach 20, but it was like for a blink. If you took your eye off the screen for a second, you didn't see it. I think it was probably a bad tick, and we really were basically around 1853, I think was kind of the top of the mark. So it was basically filling up this gap. However, volatility has a few different ranges here, the lower end of which being down here around 1153. That bing you heard was an alert I got for oil, which I will be discussing in quite some detail in a little bit. But anyway, so this is the lower end of the range here. We had a bit of a look below and fail, and we all know how that resulted in quite a super spike higher. So as long as you start getting between this like 11s and like, let's call it like 14s, 15s, that's really the low end of the volatility range. You can see we have been making some higher lows, which doesn't necessarily bode well for the stock market. You know, as volatility increases, that's really the fear gauge. I mean, in some extreme circumstances, you can get a crash up and volatility will advance mainly on, speculative call buying. But for that to happen in mass, you really need to be in a feverish pitch in the market. And for the most part, it's for the volatility elevates when there are put buyers and fear coming into the market. So we did close over 1785, which is I would say a little bit more elevated. Anything over 1785, of course, puts 20, 22s, and maybe even 25s in play. So we do have to be a little bit cautious if volatility does stay heightened. Maybe there is some protection buying as we go into the new year. We'll have to see. But anything back below there is better, I guess, for the bull case and higher prices in stocks. The dollar, I've been saying for a while, is one of my biggest concerns for the market going forward in 2016, and I drew in some kind of bracketed lines, this lateral range, and we had broken above and then got back below after the Fed. We kind of had a look above and fail, which got us back into here, but as you've seen the last few days, here these 2 days, Wednesday and Thursday, we had, Tuesday and Wednesday, Thursday was here, and then Friday, of course, we know the market was closed for New Year's. But these two were inverted hammers below a downtrend line, and then we had a kind of a gap. I mean, I wouldn't necessarily say this is a big enough gap to call it a professional gap just yet, but we did have a gap that broke downtrend over the 50 MA and kind of is threatening to get back up over the key resistance area of this 2568. Anything back above there to me really puts this move back into the 26. Really, this is like, let me flip over. Hold on. I want to, really show you this in the dollar. A lot of people talk about the dollar, so let's show that here. Anything, we had this fallback, but we are kind of threatening here. We have a higher low, And my fear here, of course, is that we take out this high and now we're starting to change the pattern back. You see, we were starting to make lower lows and some lower highs, but now we're making a higher high off, and now we potentially have a higher low. So if we started taking out that 99.35-ish area in the dollar, I think we would shoot up and see the 100 pretty quickly. And, then we're starting to get back dangerously close to, the real breakout range of 100. Once you get through there, there's really a lot of room to the upside. I don't really want to go over that chart here because it hasn't happened yet. I will in thorough detail if it does. But, you can get up to 106 mighty quickly for many reasons. Anyway, let's stick to our ETF realm here. I would be a little bit careful if we do start seeing some more powerful moves here in the dollar. So that is going to still be on our radar. The bonds. So I've been I guess I wouldn't say I've been being coy about it, but I have been hinting that I believe that interest rates, if they do start to rise, meaning bond prices going lower, could be the new oil for the market, meaning the algorithms might want to start keying off of moves in bond yields. That could become a very, very slippery slope for the market because that is real. Most stocks are valued off of what's known as a DCF model, that's discounted cash flows, and the quote-unquote risk-free rate, which is treasury yields. As that goes higher, the end product, the multiple people are willing to pay for earnings, meaning PE multiples and stock prices, gets lower because their bond equivalent yields become less attractive, because bonds themselves are becoming they're yielding higher. So the 2009 crash peak was 123.15. Anything below there I do think is a little bit vulnerable, but it isn't kind of lights out scary yet. Unless we start losing these like 118, maybe I would even stretch it maybe to 117. That was a kind of a prominent expiration, but let's use 118 for the moment, since look where the low here was to the tick, 118. So as long as we are over that quote-unquote fulcrum pivot, by the way, that quote is my quote. So as long as we're over that fulcrum pivot, I still think it's still healthy. But if you start losing the 118s, I think we're going to retest these 114s, 115s rather quickly. And if we lose this, then we have a really big problem, because you have a move down, kind of a check back, and then a subsequent move down that would have taken out that low. So this is really do or die territory here for bonds. So if we start really losing this, I will get a little bit nervous. The kind of the bright side is that there's a lot of fear of recession, and if there is recession, bonds are gonna stay bid. As the dollar gets stronger, foreign, I guess, buyers the bonds become more attractive to them because they have an appreciating asset and appreciation in currency. That's sort of I think that's really been what's been holding up the U.S. market, has been really foreign buyers. But that's for another conversation. Anyway, the key point here is that we really need to be watching this 118 and then these 123s here. You can see moves up above there have not been met kindly. There had been kind of a new up channel forming. That is rejected in sort of dramatic form. So we're going to have to see. We're below the 50. We kind of had 3 up days here, one big engulfing, and now kind of it seems like a little bit of a pattern. We go down, we rally a bit, go down more, rally a little bit, and then go down more. So this area is going to be very key for us. That has had a lot of effect on these high yield bonds. You can see we've been bear flagging here. The good news is that we're making some higher lows, equal highs. So a move here up could be quite powerful, maybe even up to the 82s, like this swing low here and the descending 50-day moving average, which has been troubling to say the least. But this pattern is still pretty precarious. I mean, we have retraced almost half of the move, more than half, I should say, of the move from the March 2009 crash lows up until their recent peak. So you can see even back here in June, this was, right? Wow, it's been a while. It hasn't even been that while. In June, this was 95, and here in December, we're like kissing 78. That's a big move. I mean, this isn't a biotech stock. This is, more high yield and bond. This is a debt instrument. So this could become a big problem. Same thing goes for the JNK. You know, there's a lot of talk about that. I mean, these are basically this very similar looking chart patterns. So, you know, this could, if this continues lower, this will become a problem. You know, I just saw that movie The Big Short over the weekend, and the problem always starts in kind of the quote-unquote subprime type of stuff, and this JNK is sort of your equivalent of subprime. All right, so that was JNK. Let's go into the Big Mac Daddy, and that is oil. So we've been kind of in a limbo here of the stock kind of USO. Let me not talk USO for the moment. I really want to talk about the real contract crude CL. And I just got an alert that it's up a bit right now. There's some tensions that are going on between Iran and the Saudis. They cut diplomatic relations. I believe the Saudi embassy was stormed in in Iran. So there's a lot of hot rhetoric coming out of two major OPEC oil-producing countries. The question now is going to be, just geopolitically, whether this is going to be a race to zero, meaning they're both going to be pumping like mad to fund war efforts and try, really the Saudis, to try to hurt the Iranians, or is this going to be viewed as geopolitical tensions and potential threat to the Straits of Hormuz, which is, of course, where oil comes out of, and the production in oil, at least immediately. It looks like people are using it as a bit of a, there's a little bit of panic, although you would think with a conflict with Iran and with Saudi Arabia that this would be way more off to the races. I mean, think about what if this would have happened a couple of, in the summer, or a couple of summers ago. I mean, you'd be talking about oil maybe at 150. But let's see how this goes. I've been talking about thinking that oil is going to bottom somewhere between 33.20 and 37. We got really close, and we've just been hugging around that area. So oil back above 37 and back above the low here, which was 37.75, is quote-unquote starting to repair a little. You can see we broke one downtrend here, not with tons of conviction yet because we have been making some higher lows, but we don't have really some higher, really distinguishable higher highs, although this was the alert that went off earlier. We did get it back above. So if we could start getting back above 38.28 with some authority, maybe we get a 50 MA retest. Maybe we retest 40, which was where this breakdown took place. I would think that would be a very logical place, and maybe there's some type of squeeze up to the 50 and maybe even to this downtrend. But we're going to have to keep an eye on this. This is going to be a big tell. If oil can't rally on geopolitical tensions between Saudi Arabia and Iran, it's probably going to revisit these lows and maybe visit even lower. If it can rally and we do start getting some fear into that market and get a squeeze going, then maybe the low for oil is in. We're going to have to see how that goes. The proxies, of course, there's been a lot of talk about people how to play oil. My favorite is really the two big integrated ones, which are ExxonMobil and, of course, Chevron. Exxon did have a bit of a bullish move up here. I had been saying that I thought we would see 86s. We actually overshot into the 87s. It has been pulling back. I did think that between the 76 and the basically 75.98 and the 74.94 would be a buy point for a bounce. It has happened. This was starting to look bullish. This was starting to look a little bit more like a professional gap. We held, kind of had a test back and then closed up near the highs, but the next few days were sell-offs, followed by a bigger gap that took out all of these days engulfing, stalling below the 50, and now kind of doing this mushy pullback here. So we have to keep an eye on this low here, this 76.65. Maybe we are starting to form some higher lows, but we don't want to start seeing these get violated. Maybe there is a gap fill here. I think if you're going to play this, the best way to do it is maybe, assuming you really want to be like long this stuff, you maybe sell some out of the money puts to get in at a cheaper price, and then once, if you're put into it, then sell some upside calls and just play that game to collect yield and also bring in premiums. That can be quite an effective strategy. I don't necessarily know if we revisit the 66s, but this mid-70 area is probably going to be in play for a little while to come. Chevron, same kind of stuff. We're still caught in a Twilight Zone marathon. Downtrend. And, we've had more multiple touches here, though. You can see the frequency of the touches are starting to, it's starting to get more and more close. You can see it was a while here. Here it was a little less distance maybe from here to here, and now we're starting to get a lot of touches. We are basically, a smidgen below the channel. Maybe basically right on it. But, this is really the area that you need to hold. You can see you basically have double bottoms here. So if you start losing this 88.21, 88.30, then I think that this could get a little bit more slippery down to the 84s, maybe even the 80s. But as long as you hold over here, that could be a good row, if you want to try long against there. So let's see how that goes. I'm curious to see how this is going to play out on Monday with oil being up on the geopolitical tensions. FXI, China has not been great. They're only expected to grow at around 6%. Boy, wouldn't we kill for the USA to have 6% growth? And China, that's like a joke, right? 40.64 was really the main breakdown point. You can see there was a lot of tension around there. Completely fell out of bed. Bear flagged, got basically the retest, and then we've just been selling off. So I've said for a while that, and then we basically look here, we had double bottomed again, tried to rally lower highs, unfortunately, but now kind of starting again with the lower lows. So China could be live again as a headline if this starts really falling apart. You really just don't want to see one of these, the kind of crash move. If it's just a slow drift lower and a slow bleed, I don't know that it's going to factor into the U.S. markets as much as it had. But, when that's not really how prices move. They don't really tend to just have the Goldilocks scenario. They're usually moving, right? Like Forrest Gump, if I was going anywhere, I was running. So China might be one of those. It might be that it's going to be either running to the upside or it's going to be running to the downside, depending on if these lows hold. If you start losing this 34.48, let's just call it half, I think you're going to revisit the lows here. We had just missed just shy of the 61.8 down here at 32.15. Wouldn't shock me if that got revisited, on a move down here, but I do think that there will be some type of a setup in that area. You can see I have some alerts set at some key levels, so it wouldn't surprise me to if we do have some type of a rollover in this area. But, the Chinese numbers, their economy is not very strong, and I do believe that there will be some more stimulus that is going to come into there. BABA just kind of consolidating, chopping around. It is a little bit more vulnerable below 82.81, but as long as we're above 77.77, it's kind of all good in the hood. A couple of little, sticking points, loose change. Momentum is starting to, the stochastics are making lower highs, and this hasn't really broken at a range. We are basically right around the 50-day MA. So if you're long, if it were me, I wouldn't be so keen if this... this is starting to get a little bit iffy here. Like I said, below 82.81, I would be a little bit more cautious. If we can stay below the 50, I would still be more cautious. And if you want to play this for, if you want to get long this and you want to get long it at like the lower end of the range, or if you want to play for like a quick short move, I like put ratios or put spreads. It's probably not a lot of juice in there, so you probably can get those on relatively cheaply. But yeah, if you start losing this area, this 78.99, this swing, which was a higher low, I would be pretty cautious. I think that if we start losing these swings, the gap fill could be into play, and I know a lot of people won't be happy about that. So we'll see how that plays out. I think a lot of the weakness here has just been all the buy the dippers from back here being made whole. You can see this is a very big volume profile node with basically 85 kind of being the tip of the spear, and look where we've kind of topped out. Just look where that is. There's been no real main sustainable moves over there, and it's just because people who were, oh, please get me out, I'll never do it again type of, reasoning and bargaining down here when this was in the 50s, have now been made whole, and they are just getting out of their pain. So I think that it's just a matter of eating up some time. BIDU, I had said I was bullish back here for earnings, and it blew through. I was really looking just for a test of the channel and maybe the gap fill. So those two targets were met. It obviously exceeded there, and now we're just kind of pulling back. I would say the best thing, you've worked off a lot of the stochastics, and you haven't really hemorrhaged terribly in terms of price. If you bought this day, you're not happy. This was a big spike in volume. So that has been working itself off. Anything below, of course, this 198.70 is a little bit vulnerable, but I do think that this could set up again if we do wind up getting weaker and maybe filling in some of these gaps into the earnings. I would be a little, like I said, a little bit cautious that we're below this low here, this 198.70, and this low here is really important, this 191, and we are a little bit below there. So and you can see we bounced off of it already, and now below breaking trend. So I'd be a little bit cautious with BIDU. Probably can play short on a retest back here somewhere between the 93s and the 200 for right or right out. But I would be I actually am kind of hoping this gets a little bit panicky ahead of the print here. But like I said, we are starting to use up. We're not fully below here, so we're starting to use up a lot of the time. Think like this, we're not really dramatically below, but we're starting to get into really a little bit of oversold territory. So that was BIDU. IBB. That's also a proxy for risk on, risk off in this market, right? That's the biotech ETF. This area has been really important for me. We have 1 touch, 2 touch, now 3 touch, and we're backing off. Since we failed there, maybe there's a move back mid-range here to retest the 50 MA, but anything that can really sail up above this 342.89, 341.25 to 342.89, I would say is more bullish than bearish. We had an old up channel. We broke it. We've been trying to get back into there. Really just making some higher lows, equal highs. We kind of were setting up an inverse head and shoulders here that kind of fell out of bed, retesting it again. So I would say that a move now back up above these, not only 2 highs, but 3 highs, is even exponentially more powerful. A move through there, I think you see the 356s and maybe even the 360s on some type of a move higher. If in the meantime you want to play for some type of put ratio with a play down to the 50 MA, hey, that sounds really good to me. Look at the strength and the holding here. Any move below there was really unsustainable. The 50 has been really important. The good news here is that it was descending here, and now it's starting to turn back up, and you have a big confluence of moving averages here. You have the 50, the 20, and the 100. The bad news is the 100 is still kind of going lower, but I do believe that this area would be a great right or right out, considering you have basically these breakout candles here, these hammer lows, and this confluence of moving averages, and kind of the beginning of the next volume distribution. So between those 28s and like 31s, I think that 32s, I think that area would be a kind of good right or right out, and to definitely play, like if you want to buy these puts and then sell 2 times out of the money down here near like the gap fill, I think that would be a smart play. Gilead not doing much other than just wasting a lot of time chopping around, kind of building a bit of a shelf here. This unfortunately is starting to look a little bit more bearish. That would be my dream if this dumps hard before their earnings, because I think their earnings will be good. I've talked in the last couple of weeks about some of my reasons why I think they're still selling pretty well in the drugs. I don't really want to rehash those, but they are below some trends. It's looks to me really like a big pennant. We'll have to see how that breaks. If you want to play it on momentum over the downtrend, that's obviously and over these highs is obviously the most safe over the 110. But I would love to see, a revisit somewhere in these 93s or even down in these like 84s, 85s to set up for a right or right out long. They held here, they held here, they held here. I mean, the more they get tested, obviously, the the less support they would provide. But I do believe, since this last one was the flash crash, that it would kind of the Lone Ranger here would live to ride again. All right, so that covers up the 6 market keys. There are, like I said, I'm going to talk about the Fed keys quickly. Those are the jobs data, which I haven't thought have been really good. I'll talk about those in the context of SPY here. I haven't really thought the jobs numbers were good, and like I said, we have been in a bit of a consolidation. Like I identified this period here as being similar to this period here. The only thing that kind of has me concerned is I consider this move down the left side of the mountain, and now we are on the right, the other side of the mountain, so to speak. This being the big year-long consolidation, more than a year-long consolidation that spanned from parts in 2013 into the end of 2015 for the most part. So with of course this panic move, a lot of people asked me early on last year what I thought was going to happen. And I had said that I thought we were going to have a consolidation year with a big dump that struggled all year to get back to basically where we collapsed from. And that actually turned out to be kind of prescient, believe it or not. So, like I said, we basically we held trend down here. We held this reference low, and now we've done everything kind of right. We went back up to resistance, came back, retested the lows, not the spike, but the pullback low, which was healthy, and then rallied up quite strong. We actually got quite high here up into the 111s, which is really the upper part of this distribution, and then had the pullback, rallied to a lower high, and now making some lower lows and some still lower highs with equal lows here. So that is a little bit concerning if you start seeing more lower lows and lower highs. I will say this, though. One big piece of a couple of really important levels here. I have said that for the bulls to really have a shot at the all-time highs and to have some type of a blow-off move where the market goes like parabolically higher, you really need to see SPY get over this key 210 and 211 area. Really, 210 is the biggie, because there was some very prominent options expirations back in the old days, and anything below there to me is a little bit more vulnerable. Anything below 206.76 and to 207.84 is still more vulnerable, and you can see where we rallied back up here, and then we've tried again, and coming back down. And anything below 204.12 to me is a little bit more vulnerable, because you can see that is kind of like the edge of where this distribution ends. There was a lot of support here. Once we closed below here, we had the cascade lower. So look what happened here again. We're now closed a little bit below there. I don't necessarily know that we're going to get this again, but I will tell you, if we start losing these lows, these double lows, and this higher low, so if you lose the 200 area, the 199.83-ish area, then I think that this could open up I heard them on TV referring them to air pockets or air gaps. I think we'll revisit the gap fill within pretty short order, at least the 96s to 93s, somewhere in that range. If we lose the 99s, I think we would have a pretty big cascade either to the gap fill, the big 61.8 from, the real low here down in the 81, what was this, 82.40 up to here. That would be the big 61.8. If you go from this low, you have a 61.8, we'd be in between that area. So these lows are going to be really key. If you lose those, you really want to be on a GTFO mode, because you'd now be making the third lower low on a separate leg from lower highs. That is dangerous types of move. I would be playing that with put spreads or put ratios for a move to play for the gap fill, for at least somewhere between 95 to 93.58. If you're more optimistic, 96.38. Somewhere in those 3 points, I believe the market would find support. We'd see some type of probably throwback rally back up to the 199s, and either we would fail and really get dangerous, or it would, accept and maybe, it was a false breakdown. It's kind of a tough call. Look where these lows were, though. They were basically at the bear flag peak. You see where this kind of came up to, and we were struggling into, and then once we got, pulled back, once we finally got through there, it was strong. So it makes sense that this area held. The expected move, I believe, this week in SPY is roughly, $4.15. So that would really take you down, really, to these 199s to retest here, although I think if you broke them, that would accelerate on some type. I think that the expected move would accelerate because IV would probably be significantly higher. And if you rally back up, that basically takes you up to here, to 208, 02-ish. So you basically would be taking you back up to this resistance area where you can see there's been a lot of volume. So that's really going to be the key for me in SPY. I will say this: if we do lose these lows and we do start taking out the 197.86, That to me is going to be, and I guess I could say that there's a little bit of give down to here, but not really. I really don't think it should be seeing this again if the market is really this healthy, because I don't necessarily subscribe to the fact that we're going to have a third year of consolidation. I mean, yeah, it's very possible. I happen to think that this year is either going to be up a lot in the market or down a lot in the market. I know that that isn't exactly the most making, predictory. I think a lot of people like to make a lot of predictions, and most of them, I mean, if I could fade every one of those predictions, I would take the opposite side of pretty much every one of those bets, and yeah, I'd be wrong a couple times, but I'd be right on so many that it would more than make up for the ones that, kind of got it right. But to me, it's all about the levels. If you, like I said, if you can take out these levels and get into this upper distribution above the 109, 110, I'll be more bullish on the market for the blow off. And if you start losing these lows here in the 199s to 200s, I am going to be much more cautious, because this is really the must hold area. If you start losing that, the market could have a much more severe correction, maybe more than most people are even think is possible. Usually, markets tend to move, or prices tend to move to extremes further and longer than more people think is rational at the outset. And it's not because of, common sense or any type of rationality. It's really out of necessity, and basically because a lot of people were positioned incorrectly. That being said, a lot of this move up in the market, or a lot of this consolidation and backing and filling has been working off of the excess of 2013, where the market was up 30%. It makes sense that you'd have a couple of years of consolidation. It's actually fairly healthy, but, balance leads to excess, and excess leads to balance, and then into excess again. So we're going to have to see. I would not surprise me. I know a lot of people are bearish. It really wouldn't surprise me, because we are within spitting, believe it or not, still within spitting distance of all-time highs, to see some type of last hurrah blow-off. I mean, that would make a lot of sense to me. It would probably set up for an amazing short opportunity once that position for maybe multiple years of shorts that you could pyramid into, but I'm not really seeing that just yet. Like I've said, I've been very concerned about the narrowing of the market breadth. It's really just been into a few sectors. We'll get into the FANGs in a minute. IWM is another really important indice that has been relatively weak. We are below these lows. You don't really want to be below these lows. I've said anything above 117.37 is a little bit more healthy. Below there is less healthy. And really, for the key for this to go higher, you need to be above 120.58. Again, we're not, the end of the world away, but we are now kind of bear flagging here. It is concerning that we're below these swing pivots, and we are, retested the 61.8 of this move for quite some time. I do believe, though, that we did get the gap fill, so that responded, but you start retesting these levels again, it could get a little bit squishy and retest these 107s and maybe even retest these 103s. I don't mind playing put ratios in this if you want to play it that way. I believe this right now. I'm going to say the key pivot. You can see there's a lot of volume at 115, and that was also the highs here. So I think below 115 is vulnerable. Above 115 to me gets a little bit more terra firma, so to speak. The Nasdaq has been what has been holding this market up, and it's no surprise. The Facebooks, the Amazons, the Netflix, the Googles, even the Apples to some degree have been holding this up fairly strong. We are basically just chopping around the highs. We are nowhere near these Fibonacci levels. I would say that the 105, if this came down in some dramatic fashion, would set up for a good right or right out long. I wouldn't mind playing put ratios for a move down there, or even selling out of the money puts if you do come down into that area, if you want to kind of play it the Chicken Little way. But this is going to be really key. You can see we lost the 50 here. We are just in chop mode, and I think a lot of that is going to depend on these following stocks. The most concerning, which, let's just go right to the 800-pound elephant in the room, and that is Apple. You can see that this is looking like more and more like a big rounded top. You see that there's some symmetry here. This was sort of the head. This could be a big left shoulder. This could be a big right shoulder. We are now making lower highs, starting to make lower lows again. Lost this pivot here. I think the expiration really held this on Friday at the 105, but the good news is that there might be some interested buyers somewhere around 103. You can see here, this was the big breakout, 103.74. So I believe 103s are important. 100 was also the old high back when Apple topped before it had the big pullback. So there'll be a lot of kind of reflexive or mechanical buyers down at 100. I'm not necessarily so sure that we're going to completely fall out of bed here. I mean, look at this. We do have lower highs in the stochastics, and this is bombed out. I mean, Apple is kind of due for a rally. I would love to see this get panicky into the print where you get a bunch of days down. I have it anecdotally that some people are saying that the iPhone 6S isn't selling as well in China, that people are waiting for the 7. I know a lot of people, including myself, are waiting for the iWatch 2, which is coming in March. So we're going to have to see how this plays out. If Apple rallies ahead of the print, it gets to me a little bit more iffy. That's probably what will happen. But for me, the best scenario would be is if this does get weak and we start retesting, into the 100 or maybe even lower, down into these 95 levels. I've said for a while that I do believe that it could potentially even retest 85, which would coincide with the big 61.8 and potentially an uptrend line if by the time it got there. I don't necessarily know if that's going to be something that you could really play for unless you're really super long dated in options. But I do believe if we do start getting a little dumpy and panicky, and I do have some put ratios on, so in some degree I am talking my book here a little bit. But I mean, look what happened. I mean, you basically retested, you broke the trend, you retested, and now you're making new lows below this last swing low. I mean, the chart is bearish. I'm sorry. You're below these swing lows, all these swing lows. And I do think that this area is going to be the sweet spot maybe early next week. The one caveat could be is that it's a new year and some funds might decide to buy some Apple. It is a big retail name that people buy into, so maybe it kind of gets saved by the bell, the starting bell for the new year. We'll have to see how that plays out on Monday. The last couple of years we've been a little soft the first week in terms of the markets. So we'll have to see how the January effect, if it even does play out this year. Below 109 is vulnerable. You can see there, we stalled there. Below 107 to me is still more vulnerable, and to the 103s and the 100s. So I do believe that this area will set up for some type of a right or right out bounce play, particularly if it's, on like the 5th day down or something into like the 100. I believe that selling some out of the money puts there might be some near dated out of the money puts there might be prudent. Let's just go right to it, to the FANG. So Facebook has just been in this consolidation mode. I had said it reminded me a lot of this period of time. How we got this move was very similar to how we got this move. It was a little bit on its own volition, and then we got Google earnings, which kind of spiked it. Same thing here. We got the 1.618 Fibonacci extension and then some. This had been my big call, actually, for 2015, that Facebook would see 100 plus, and it did. I believe Facebook, believe it or not, could double. I just think that I'm long-term bullish, but I'm near-term cautious because we saw how this kind of resolved. It was down initially, so if you start breaking these lows, it starts getting a little iffy. Maybe there is some type of a pullback. Again, if I had my druthers and we are coming into some lower stochastics, I would love to see this get a little panicky ahead of their earnings, which I think will be good. Maybe find it. I think part of the reason for this has been we didn't get the full retest of the breakout of the 99s, so we didn't kind of have the fully cocked slingshot, so to speak. And it's just been a little iffy. 50 MA has been very key. We are closing a little bit below there here, and we're kind of at the tail end of the range in these 103s, 104s. For me, like I said, if I had my druthers, I would love to see this pullback somewhere between 93. Really, the best scenario would be to 86, but I don't know that we're going to get that low. I do think, though, that we could see between 99 and 93 if the market gets a little squeamish early and we do get a little bit larger of a pullback. That to me would set up as a nice right or right out type of a play, and it coincides with some Fibonacci levels. I kind of X'd this out, the flash crash low, and I just used the pullback low. Although look where the flash crash low basically held to the tick, the old top in the 72s. So the technicals on this have been working rather well. I think that 61.8 area would set up as a great area to kind of play row, right or right out, buy. Maybe there's a little bit more give. We'll see. The 91s we know were an important level, but I'll probably be a put seller down here, particularly if it's like multiple days down fast. That to me would set up great. The IV in there is a little too low right now to play to sell premium, so you're really playing directionally, in my opinion, either long or short. Amazon. So we all know that this year, I would say, was really the year of Amazon. I mean, look at this chart. This thing it's just a monster, right? It's up a lot. The question is going to be, is all these people who are long and right, are they going to now start taking profits into the new year now that they don't have to have, they have another year to pay their taxes off, plus this ran up so much. I will say also, you had a bit of a false breakout here. Anything above 684.82 would be, to me, still be bullish. You had a pullback here. This day was this is actually still a bullish candle, this little harami, but now that you lost that low and you're back below that candle, this to me is getting a little iffy, looking like maybe a look above and fail, just like this was a look below and fail. So I'm a little cautious here on Amazon. I don't necessarily know. This basically got over the 1.618 fib extension, which I had been predicting. It even did $30 more than that. I mean, think about this. If you bought pre-market this day, you were up $30 by the close the following day. So, I mean, it's like this moved quite a bit, and I think a lot of the smart money said, 696.44, close enough for government work to, to 700. These big funds have to figure that there's going to be a lot of other sellers there. Sometimes they front run, and they did. And, I wouldn't say that there's really any danger in this Amazon yet, as long as it's still holding above the 660, 64. But it wouldn't shock me to actually see a larger pullback. Again, they're probably going to have really stellar earnings, really amazing. And this is coming off of an all-time high. The best thing that could happen to this is shake out all of these weak hands who have been chasing, and this thing have more of a dramatic pullback, maybe even fill up some of these gaps ahead of their earnings. God willing, that would be an amazing setup. And then, play it long for a little bit, like sort of a shake and then bake. But like I said, this is still in just consolidation mode. We're basically back to the mid-range here. There's really nothing that I can say about Amazon other than below 660.64 is more bearish. Above 684.82 is more bullish. It's really that simple. One of the big Momo names of the last year has been Netflix. I took a lot of heat. I was saying that this was looking double topish and that this was looking very similar. Of course, I was called a moron and a dummy and the usual epithets that I attract when I make calls like that when people are positioned the other way. However, I do have the benefit here of having to have been right. We got the pullback to 115. I said that was kind of the right or right out area. Bounce got perfectly to the 126s, basically this top part of this resistance of the bodies, and now starting to tag the 115 again and again. Friday we were below the 115 with a close below and below the 50 MA, so that to me is a little bit getting a little iffy. Any break there could see the 110s rather easy. That's that was another breakout and a big key strike. It's also the lower part of the channel. I would say that could be a right or right out day trade. You probably get at least a few points in a bounce between the 109s and the 110s. But if that snaps, then we're back into talking about the 103.88 and the 105s. And, we really never have filled up this gap from the breakout, the 70s. I don't necessarily know that that's going to happen, but if we do really have a true double top in place, it really wouldn't surprise me to see this, retrace a lot more of these gains. Right now, though, like I said, we're still in the channel. It hasn't broken yet, so it's way too early to call that. There would be other triangles to fill up before, and I'm sure these areas would be bet with buyers for people who missed this and who want to try it again. We have used up a lot of time on the stochastics. Again, the best scenario to me would be some type of a shake and bake where we do get some type of a larger pullback off of an all-time high and then set up for a long for maybe some type of throwback on earnings. But like I said, a little bit cautious below the 115. If you're long, you might want to buy some put spreads or put ratios to hedge off some of that position. Google, Also a monster, made some new highs. I have been saying, though, we are getting a little dangerously close to these channel highs. I think that there's a lot of people front-running the 800 a little bit here again, pulling back. Out of all of these stocks, this one probably has the lowest PE multiple, so it's kind of hard to knock Google, but I would just be a little bit cautious with this. It wouldn't hurt to put on some protection. The 50 MA held here. I will say that anything above the 50 MA still, now that particularly it's over the gap high of the 752.05, remains bullish. Anything below there to me gets more iffy. You can see that we had the gap. We did have this. We ran up, consolidated. They did the alphabet launch, and then it pulled back and filled the gap. Maybe that would be amazing if, again, that happened ahead of the earnings for another type of shake and bake and really took you mid-channel and gave you kind of a true play. It would become a little bit more of a, a little bit better risk reward playing, for a few points to the upper part of the channel, as opposed to being, in the middle of the channel and then having the opportunity to go either to the top of the channel or to the bottom of the channel. So let's see how that plays out. Like I said, still a pretty bullish pattern, still in an uptrend here, just being barely, but still in an uptrend, still above the 50, kind of hard to knock. If you want to play this, I would probably wait a little bit more till we get closer to the earnings, though, if you're first foraying into this stock now. Anyhow, I think we've gone long enough. If you're not following me, follow me. I'm on Twitter. My handle is @JustinPulitzer. I have a new Instagram account where I post 15-second videos pretty much every morning, and it talks about the keys that the market is keying off of. That's Justin Pulitzer Trades. Please leave me some comments. Hit the like button if you like this video, and be sure to subscribe to my channel. Just hit the subscribe button below. That way you'll get notifications when I post new weekend review videos, new Periscope, rebroadcasts, and special edition videos. Anyhow, that's my story. I'm sticking to it. Let's have a great 2016. Look to my stream for some trade ideas. I'm probably going to have some good ones this week and next. So let's have a good week, and cheers.